We have a special episode of the Accountant's Flight Plan prepared for you today. You are about to hear a recording of a special private equity M&A market update webinar we held recently featuring your host, Brandon Poe, and our regional market leader, Morry Brown, formerly of Goldman Sachs. We hope you enjoy.
I'm Brandon Poe, and this is the Accountant's Flight Plan podcast, where you can enjoy engaging conversations about mergers and acquisitions and accounting practice management. Listen in on strategies to build a more fun and valuable accounting firm. Thanks, everyone, for taking the time to be here today. We really appreciate your time and attention. We've got a very informative hour planned for you guys. I think you're going to get a lot of information. It might feel a little bit like you're drinking from a fire hose here, but we'll hope you find it very, very informative. So here's our agenda. We're going to talk about leverage, the concept of leverage, and just creating that competitive environment. If you're selling this, we primarily designed this from the point of view of someone who owns a firm and is thinking about selling their firm. We realize there'll probably be a good number of buyers on this presentation as well today, and hopefully there'll be some information for everyone. We're going to go over a little bit about us, our preferred status for PE buyers, and what that looks like. We're also going to go into discussions about how firms are valued. It's a very dynamic market right now, so we'll give you some good concepts to help you understand how what you're doing in your firm drives value. And then we're going to leave some time for Q&A. We're going to have to move through this material very swiftly. We've got a lot to cover. So without further ado, I do want a little bit of housekeeping though. Ian, will you kind of come on and just mention the things that you were going to mention about chatting and the Q&A?
Yeah, absolutely. So we've got a chat feature and Q&A. Oftentimes the chat will keep rolling. So if you've got questions that you'd like answer, click that Q&A tab, and that way they'll stay at the top of the list and they'll stay on our radar, and we'll make sure to get to them at the end of the call. And yeah, again, Brandon, you had mentioned it earlier, but for those who are joining now, if you want to maintain anonymity in the chat, you can change your name. There's a feature on the little 3 dots in the corner, so that way you're not visible. So yeah, that's kind of it, and we'll keep cruising. I'll be the one in the chat sharing links to downloads and information for you guys, so you'll see my name popping up as we go.
Yeah,
but that's
you
it.
might recognize Ian's name. He runs our Accounting Practice Academy. So if that name seems familiar, maybe that's where you've seen it.
Probably seen it around. Yeah.
So
Love it. All right, okay. I'll leave you guys to it.
All right, awesome. Quick intros. I'm the founder of Poe Group Advisors. Started selling CPA firms in 2003, so I've been at it for a little while now. I started my career at Ernst & Young, and we started the Accounting Practice Academy in 2020. So that's a little bit about me. I'll let Morry introduce himself.
Sure. I didn't come up the CPA side. I came up the capital market side. So I was at Goldman Sachs and Citigroup for a number of years. Joined up with Poe Group in 2021, and I lead the California market.
Awesome. All right. Thank you, Morry. All right, a little bit about our company. If you're not familiar with us, we exclusively sell CPA firms and accounting firms and tax firms in the U.S. and in Canada. I would encourage you guys to check out our website. We have a very resource-rich website. We've written a couple of books that have been published by the AICPA, a couple actually that have been picked up by CPA Canada, and we've been shown and published in numerous other accounting publications. And we've got several books. We have one of the top podcasts in the industry. If you haven't listened to our podcast, please check that out. And our blog is also a top 50 blog in the industry. So just, go to our site, play around, look at the resources. There's a lot of information there. All right, I am going to let Morry kick us off. his background with Goldman Sachs has been very helpful for our team because when private equity kind of entered this industry, I would say it really entered heavily 3, 4 years ago. Morry's been very helpful at helping us navigate this changing market. So I'll let you kick it off, Morry.
Sure. Yeah, I think 30,000 foot view here from the PE side. When you get committed pools of capital and they come into a sector, often one of the classic playbooks is a roll up strategy, and it's fairly clear that that's what's going on in the space right now. Many of the groups that we talk to on the private equity side, the committed capital kind of tends to range from somewhere between 50 to say 200 million. And what they tend to look at for various sectors when they start to roll them up is a fragmented industry where there's not a ton of concentration, and there's advantages to scale. And so as they've looked at the CPA space, I think that's what they're seeing in addition to favorable industry and cash flow dynamics. So generally, these are fairly attractive from a valuation perspective. And so they are looking to roll things up. When they look at the portfolio, they're thinking about it from the standpoint of how do we take this capital and scale quickly. So it's attractive to them to look at firms that have higher revenue levels because it's the same amount of effort for them to integrate a firm that's smaller versus a firm that's larger. So they're looking at the whole portfolio. What that means for potential sellers in the CPA space is that if you're talking to private equity, they're probably talking to a number of other firms similar to yours. And so if they're going to try to make, say, 10 deals in a given year, they're probably going to make, LOI type offers to, 20, 30, maybe more firms like that. They'll put out their offer and they'll kind of see where there's a deal where the valuation is attractive relative to what they're getting. Some of these offers can be all cash at close. Many of them, though, are offers that we talk about as NFL style offers, where the headline number can be very high. Under the hood, it's very important to understand how much of that is cash at close versus how much of that is cash at risk in the future, either via earnout or equity rolling into the new entity. We'll get into some of those topics in more detail as we go through this today.
Yeah. And none of this is really, I don't look at this as a negative in any way. It's just the way this operates, right? They have capital. They want to have that capital earning quickly. They, want to deploy their strategy. And in order to deploy that strategy, they have to talk to a number of firms, and they realize they're not going to get all of those firms. And so they're fishing, right?
Correct. It's kind of a sales filter, like anyone running a sales strategy.
Right. So, and our buyer team is probably talking to 10 different PE firms a day. There's, I think, new ones popping up all the time, and there are a lot of differences between these firms. And also, not to we don't want to lose sight of the fact that there are a lot of other buyers in the marketplace as well. And those that is still a very active market too, with other firms and individual buyers. So just something to keep in mind as we go through this. All right, Ian. Okay, so negotiation. So this has been our experience. I think this is kind of checks out with your experience too, Morry. I think they want to move fast, and they do have a sense of urgency. So I think what we tend to see is LOIs get issued pretty early in the process. One thing about LOIs, and we have a white paper around LOIs, around some of the pitfalls. Maybe we can get that in the chat now. But they want to get an exclusivity clause, and I always joke about the LOIs because the one thing that's binding in a LOI is often the exclusivity clause. Everything else is negotiable. So, they're often going to move quick. and you might not have decent backup offers if you move fast and kind of lock into someone right away. You're not going to get that competitive process once you commit to a single buyer. And guerrilla terms on the back end. Would you like to elaborate on that a little bit, Morry? What that term
Well,
means?
sure. I mean, I think when you see an LOI that comes with the initial terms, and then as you pointed out, the sort of exclusive negotiating period, what can often happen, right, is that as they go through the diligence process, other terms come up, and so the price or the value that they're quoting that could change. Also, what could change would be, the terms underneath the hood, how long the retention is, what the employment agreement is on the other side of it. All of those factors, tend to be not as rosy as the initial LOI. And so I think when people see those terms, understand there's probably contingencies under there that you may not be thinking about as you're signing. The other thing would be, they're probably negotiating with other firms at the same time, and so their interest in your particular firm can wax and wane depending on how the dialogue with other firms is going. So if they're having difficult negotiations with some firms, that could increase their interest in yours. However, if they've say made a firm purchase agreement and they're going to close with a couple of other firms at the same time, that could reduce their interest during this LOI period. So I think the key takeaway to for the audience is, understand that the LOI, is not binding, and that it's an indication of interest, but it's generally not much more than that unless you have, some sort of relationship with the firm and have an understanding of what they're looking to do.
Yep. All right. Okay. So we're going to talk our own book a little bit today, and meaning that, well, Morry, will you explain that one? Because that's a term I learned from you.
Yeah, basically talking in our own self-interest here, right? We are a broker, and we make a market for practices, and so I think not surprisingly, we believe that we create a more competitive environment and give sellers more leverage as they're negotiating with more sophisticated buyers that are likely also looking at multiple practices at the same time.
Yeah. And we want to highlight this one particular deal, CA 2011. This was a deal that was in San Francisco. It was one of Morry's transactions, and you and Lawrence worked that deal, and it was sold to a private equity firm. We closed at a 9x multiple of EBITDA and had an 86% guaranteed payout. The majority of that was cash at close. So we are seeing some of these larger firms. This one sold for over $5 million. And I think does the next slide have some details on that? I can't remember, but no. Okay, sorry about that. Fast forward. This deal actually closed with a backup buyer. And Morry, do you want to kind of tell our audience a little bit about what happened there on that deal? Because it unfortunately collapsed kind of last minute with the original contract.
Sure. So as we all know, a deal is a deal until the final documents are signed. So in this case, the seller had negotiated. They were getting close to close. It was kind of early January, coming back after the holidays, and the buyer basically backed out. And so, because we ran a competitive process, we had multiple backup offers in place. It was January though, so tax season is about to start, and it's very difficult to have the time to do a transaction during tax season. So there was a 2-week window that we had to close this deal with one of the backup offers. That firm came in, they moved quickly, and we were able to close that deal prior to tax season. And so I think that the takeaway here is that having multiple buyers in the process and having those backup offers, it puts you in a stronger position to not only to negotiate terms and value, but also in the case of something going wrong, you've got options, and you're not kind of left out in the lurch and having to head into a tax season that you weren't planning to to continue through on your own.
Yes. And I will say, like, it really helps to have, knowing that those backup buyers exist helps you stand firm during the, during the due diligence period, during the purchase agreement negotiation period. It really does help you, give you a lot of leverage just during that time. So another thing to think about. All right. And I'm getting a lot of these. Are these chats? Are these people putting stuff into the chat? We really want. No, they're going in the Q&A. They're popping up.
There's some going into the Q&A. I'll just let you. I think we've had a lot of people join in the last 10 minutes or so. So if you've got more questions, it's often easiest to keep track of them all in that Q&A section, guys. I'm keeping track as well, but if it's just the same to you, if you can pop into that Q&A, always makes it easier. But yeah, we got a poll coming out right now, so take a second and fill that in.
Yeah, it looks like about a third, 25 to 30% of people have been approached by PE. I'm not surprised by that number. Actually, I'm not. I was kind of thinking it would be higher. So, all right, good stuff. All right, we can keep moving here. All right, we got a second poll, back to back. Of those that said yes, you've been approached, how many of you have actually gotten unsolicited LOIs? Like, hey, I've gotten offers. A few. So you can kind of get a sense of how this market is behaving right now. It's a interesting market. Been in this business for a long time, and seeing this happens, it's kind of an exciting time to be in the accounting industry. So, we kind of emphasize here, we have developed a very professional M&A process on our side. We're going to share a link with you to our process. But, if you want to be really strategic about selling your firm, it's not just about having a handful of buyers. It's about finding the right buyer in a very competitive environment. And that's how you get the right terms and the right fit. And, again, I mentioned our process. We're going to send out an email after this and give you a link to our process. We have a little 2-minute explainer video, which I'm not going to play that right now. But if you would like to get an overview of how that works, here's a link now, and we'll send you an email later. Okay. So just to kind of drive this point home, if you were selling anything, if you were selling a house or any item, would you want one buyer? Would you want 100? It just kind of drives home that idea of supply and demand. Obviously, the more buyers you have, the more likely you're going to get a more favorable deal. So, again, we have other types of buyers too. Private equity is not right for everyone. It's a big decision. It's right for some, it's not right for others. So there are a lot of, we've got thousands of relationships nationally with other firms, with individual buyers, and private equity buyers as well. And what this, I think this is the biggest benefit of all. And that is you get to focus on the fit. And I talk to CPAs just about every day, and the vast majority care deeply and sincerely about their staff. They care about their clients, and they don't want to leave them in they want to leave them in good hands. And so, having a big buyer pool, there's a lot of differences between these PE firms. There are some very good ones and some people, what I put them in the category of patient capital, where they have a longer term view. So there's some really good PE firms, and there's some other reasons for picking other firms, and we're going to get into that. But um, I find that clients who focus on the fit ultimately end up with better transactions all the way around, better price, better terms, um, and just a better deal. Yeah, and if you're selling a PE and you're going to stay with them for a while, that culture becomes even more important. Morry, do you want to touch on culture? We had a good conversation about this earlier in the week.
Yeah, yeah. I mean, I think, if you look at, evaluating a larger buyer pool, again, what it does is allow you to focus on things like this that are softer features, right? The culture of the firm, what's the vision of the private equity group if you're going that direction. And I think, squeezing out an extra, 100 or $200,000 in the purchase price is probably not going to change anyone's life, right? But if you make the wrong agreement with the wrong group, and you've got, 2 or 3 years to work out, in a culture that you're not aligned with, that can certainly have a negative impact on you, right? So I think it just reinforces the fit dynamics. And when you've got a competitive process, usually the price and the value become sort of market driven, and it allows you as the seller to really focus on fit and make the agreement with the right buyer, where you can feel good if you're planning to stay on, for 2 or 3 years to go through, a private equity process.
Yeah, and I want to touch briefly on transition. I want to elaborate a little bit on that. I think the majority of the private equity firms that we talk with prefer that partners and owners stay on, but that's certainly not a requirement for all of them. There are several that have pretty deep benches on their team. They've already acquired several firms and they have talent, and they can um, allow a seller to exit pretty quickly. But the vast majority, their preference is to keep you on as long as they can. Okay, we can go ahead. Here we go. Okay. All right. Morry, let's talk about power dynamics here.
Sure. I mean, I think again, this is a fairly basic setup, right? If the counterparty on the other side, the private equity group you're speaking with, if they're out there talking to 8 or 10 or 20 firms at once, if you're just talking to one, two, or three firms, you're at a disadvantage just in the negotiation because you have fewer options. And so what that typically leads to in negotiations is, the buyer will suggest, XYZ terms. And if you've got fewer options, you're kind of trying to preserve the deal, and you're at a situation where you feel like you kind of have to give to get the price you want, or to get the employment agreement that you want. Flipping those power dynamics by running a strategic process to get a number of buyers at the table. Now you're able to, if somebody, suggest terms that you're not into, you can hold firm and just say, I won't accept that, right? I want more cash at close, or I want the employment agreement to include, these terms. You've got more flexibility, and you'll also see the different groups will propose different terms, right? And so they might even propose things that you haven't thought of. Some might be positive for you, some might be negative, but again, you get to sort of work those agreements out and come up with exactly what works for you, and that can really only be done if you've got multiple parties at the table.
Yeah. Okay. Okay, we've alluded to this already, but there are long-term oriented firms. Morry, I'll let you kind of kick this one off.
Sure. Yeah, I mean, I think this is also about alignment. It's not so much about good versus bad, right? Each firm is going to have their strategy and how they think about exiting. Some are long-term oriented, so we've talked to groups that they might look at it as a 20-year plus time horizon, and they're probably going to run the firm, fairly similar to how many of you on this webinar run your firm, where you're maximizing cash flow and you're running it for the long term, right? You've then got some that want to package a few firms together, scale that revenue, cut the cost, Usually that's going to take somewhere between 3 to 5 years to kind of get to a mature firm that's really humming. And then they'd look to exit at a higher valuation multiple then. I think the point with either of these strategies is that it's got to align with how you as the seller are thinking about your future. So if you're if you are wanting to continue 10 or 15 years, you're kind of mid-career, and someone's looking to, they've already started the process of rolling up. Maybe they've acquired 3 or 5 firms to this point, and you're getting rolled up in there, and there's an exit that they're planning in 2 to 3 years. If you're looking at more of a 10-year window, then that could be misaligned, right? So this again gets back to matching the fit of what you're looking for as a seller with the strategy of the PE buyer, which again can be vastly different from group to group.
Yeah. Okay. Okay. So, we do have kind of a list. It's a rather informal list at this point, but it's, we're kind of honing this as we go, but we've got some very good relationships with, several private equity firms, and we've done deals with several that we're starting to really have good relationships, and we want those relationships. I think, this this consolidation period is going to be around with us for a while in this industry, and it's just a fact of life. And I know, I think we've all, we go to a lot of the conferences in the industry, and we talk to a lot of thought leaders and, people who are kind of at the forefront of this. And I think there's, you do kind of hear, I've heard some negative things about, oh, I heard about this PE firm that took over this firm and it was a disaster. We've heard those stories, and with some of the buyers that we have spoken to, we can see why that might happen. Especially in the beginning of this, I think we're still early in the early innings of the consolidation period. And so, there's some very inexperienced firms, inexperienced with this industry coming in, and they're bound to make some mistakes. But what we're looking for, we're looking for people who are good to deal with, who are reasonable in their negotiations, they're honest in their dealings. So we're looking for, a good relationship with people who are very honest and clear about their vision, what they're looking for, so that we can help make a good match, and what they're adding. A lot of these firms have really intelligent strategies. In my opinion, they're doing a lot of things right in terms of blending the cultures of the firms that they're acquiring. That's something that I personally like to hear about when I'm talking to a PE buyer, is how they're going to blend these cultures. And I've heard some very creative ways that they're doing that, and how they're sharing best practices among the firms that they're purchasing. So, when done well, these consolidations can be an exciting time for staff members and owners and retiring partners alike. So, those are the kinds of things that we're looking for. We're looking to understand, what they want, and try to match that with sellers who will fit with that desire. So, yeah, and we kind of run this way with all of our buyers. And
I want to go into the relationship versus transactional approach in the deal process, because I think it's a fairly key theme here when you're talking to a PE group. Again, all of them can be different and run different ways. But if you go into deals, looking to build relationships to align incentives with the acquired firm, to create value for both parties, right? That's what we like to see, as opposed to when we call it transactional. What we're meaning is effectively the two sides approaching it as if the negotiations are sort of a battleground to try to get the needle moved the farthest over to each other's respective sides, and it's a zero-sum game. If you start negotiating with someone like that, that tends to be a bad sign, right? Because it indicates that if they're feeling like their strategy is going to be that we're going to, get the most aggressive terms on the front end, rather than build the relationship for the long term. It kind of shows you what the running of the firm is going to be like on the other side, right? So we definitely prefer the groups that are going to take a relationship-based approach and set the terms of the deal to allow incentives that work for everyone. When we say deal simplicity, I think one of the other things in the context of doing any type of deal is the simpler and more straightforward the structure is, the better. Once you get into complexities, that's where you're now negotiating things that are probably more zero sum versus if you stay high level, you align the incentives, you're typically going to end up with a much better relationship on the other side.
Yeah. Yeah. So, I'm imagining we have quite a few buyers that are probably signed up for this presentation today. What we're doing is, if a seller is open to a private equity buyer, and not all of them are, we will kind of go to our preferred group first once we have a listing that is on the market. And as I mentioned, we want these relationships. And if you're not registered, there's the buyer registration. If you are a buyer and you want to register and see the firms that we have available, you can click on that link. All right, we're going to get into valuation. As Morry mentioned, the higher value, the higher the revenue, the valuation actually goes higher. This is a complete reversal of 4 or 5 years ago. It was, it was very common for, I would see deals, actually the multiple and the terms weaken as deals got bigger. And that is completely the opposite now. I think one thing that private equity values not only is the ease of integrating an acquisition with the other firms that they've purchased, but a larger entity, it just naturally becomes more stable and predictable as it gets bigger. And accounting practices are that way too. There is a benefit of scale. So what we're seeing is, if a group comes in, they typically want their first purchase to be in that minimum of 5 million range. Some of them want more. I've talked to some groups that their minimum is 20 million. And once they have that sort of one single firm in place, then they'll add to it in smaller increments. So it's not uncommon for them to go down even to the $1 to $2 million annual revenue firms. When you get under $1 million, that's probably typically too small for a private equity group. So anything over 5 million is going to probably you're going to see higher valuations as you go up. And as you go up, we're seeing that accounting firms traditionally have been valued based on multiple of revenue. And I see Ian just put our key factors report up there. We're actually in the process of rewriting that, because even though we updated it 2 years ago, the market has changed significantly just in the last 2 years. And you'll see in that report that we're basically saying firms are a multiple of revenue. Well, now we're much more seeing private equity firms in particular looking at doing acquisitions on a multiple of earnings. So we're seeing these multiples change. 4 to 7.5 is a fairly common range, and we've seen some higher ones, but there's always some fine print around that. I'm gonna let Morry talk a little bit more about, again, it's those NFL headline offers. So we want to remind you
Yeah,
of
I
that.
think the devil's in the details always when you're talking about valuation quote, right? So you'll hear somebody just kind of say, oh, we made an offer for 7 times EBITDA, but how much of that is cash at close? How much of it is guaranteed? How much of it is at risk based on an earnout or based on retention? How much is rolled up equity, right? So those numbers are quoted as one single point, but it depends on how you look at the entirety of the compensation. So I'd say that's a key thing to understand, is that not all deals look the same, right? 7 times is very different if that's all in cash versus mostly on, an earnout or rolled up equity. The other thing I would say on the size of the firm is that and the shift here from revenue-based multiples to EBITDA-based multiples. The impact of private equity, it's not just affecting the larger firms, which of course, the largest impact is kind of the 5 million plus firms, but that's filtering down, as Brandon mentioned, as low as, a couple billion in revenue. And the shift, because of the favorable cash flow dynamics of most CPA practices, you're going to end up typically with a higher valuation if you base it on EBITDA, because most of the firms that we're talking to that are kind of considered higher quality tend to have cash flow to owner of 40 to 50%. Now that doesn't equate exactly to EBITDA, because you've got to have, some sort of salary on the other side. But if you're getting, 4 to 7 times EBITDA, that's almost certainly going to be a better total valuation than if you're looking at, 1 or 1.2 times revenue. So again, I think the presence of these large pools of capital in the space are a positive for valuation across the board, even down to the smaller firm size.
Yeah. All right, so we're going to talk a little bit about kind of what drives value, what most buyers are looking at. This is all buyers are generally looking at these things. They're looking at the fee quality. One of the things I have noticed with our Accounting Practice Academy is underpricing is a pretty big thing that happens in this industry, and it's also represents an opportunity for price increases. I think a lot of these PE firms, I think you're going to see fees go up in general in the profession. And maybe private equity will be at the forefront of that, and that'll probably help everyone in the long run. They're looking at quality of clients. High net worth clients are preferable, and larger businesses are preferable. The team, that's a big one. Most of these firms are very well aware of the talent challenges in our industry. They want, teams that have, have been a longevity. They're looking for longevity in the team. And generally they do prefer owner partner retention. When an individual buyer purchases a practice, we typically recommend a pretty fast transition. These transitions are a little bit different and much more nuanced. In terms of billing, retainer-based is preferable, value-based is preferable. And then obviously the terms are going to impact the price. You can't have a conversation about price without understanding the terms, as we've mentioned. Now, the nice thing about these things are the things that you can kind of do to prepare for a sale. If you own a firm and you're not ready to entertain an exit anytime soon, these are things that you can position your practice well. Ian, we might want to share our preparing book with our audience. If you can grab that link. I don't think we had prepared that one, but that book, it's a short little read. It's about 50 pages. Can get into more detail about these things and how you can make positive changes if you're a few years away from selling. Okay. All right. Morry, take it away.
Yeah, so when we look at deals, and again, when I'd say we did the poll earlier as far as the number of people that have been approached by PE. So it's pretty common now when I'm talking to sellers in California that they're considering an LOI from a PE group, right? And so when we think about ones that we would kind of consider the NFL offer, or ones where most of that number is at risk or in the future. What those deals tend to look like is 50% or lower cash at close, and I'd say the common numbers there that I hear in the market are anywhere from 25 to 50% cash at close. the employment agreement would include, again, this is an example of the bad offer. Employment agreement would include below market comp, or it's not even stated in the LOI. The other thing would be what's the exit plan for the PE group. So if some of the equity is rolled up, often the exit multiple they'll put on that, it would be a 9 or 10 times exit multiple. And some of those deals are out there, and some transactions have gotten done at those levels. But I think to sort of assume that and kind of count on that type of exit multiple is not really prudent if you're looking, if you're looking to sell at this point. I think you compare that to what we would consider good terms would be 80% or more cash at close, a fair, employment agreement on the other side, and then some sort of realistic upside potential, whether that's equity, whether that's incentive targets. But I think that looks closer to the type of deal that we try to bring for our sellers when we create a market. And I think again, if you're getting sort of an LOI from a one-off group, you tend to see something like 50% or less cash at close, and that's one of the key triggers for us.
Yeah, and this last one about control, I think that's one that people need to reflect on carefully. Is if you've run your firm, if you've been a managing partner for a number of years and you've had complete autonomy and control, and suddenly, if you take someone else's money, they get to make the decisions. So I think you have to be realistic about what that workout period is going to look like for you. And if you lose the control, but most of your deal is at risk, that's not a good place to be. That could be very frustrating. So also something to think about. All right, we are getting towards the end here. Yeah, would you like to have us contact you about either selling or buying? And while that poll goes, we do have a seller registration form and a buyer registration form. Maybe we can post those here as well. Well, got a lot of people interested in talking. Okay. We'll keep that open for just a little bit longer. All right. Get this out of the way. We also, if you're particularly interested in an evaluation, if you'll fill out this form for us, this is about a 5-page form, and it'll give us some general information about your practice, and it will allow us to give you a range of what we think the market would bear for your practice. And I think that PDF is being put in the chat, so we'll share that. Just grab it, and you can email that to us at info@, that's info at poegroupadvisors.com. There it is.
I'll chime in here real quick. We got 2 different versions. This is the US version, and I'll also upload the Canadian version here in just 1 second.
Yep. Okay. And a couple of, I think this link might have already been shared, so it should be in the chat, but we have a pretty nice size white paper. This was written in 2024. As I mentioned, it is a very dynamic market, but there's some really good considerations for you. And look, private equity is not right for everybody. We're upfront about that, and this paper can help you better discern if it's right for you or not. Okay. We got some time for Q&A. 15 minutes, just as planned. And I know there's a bunch. I'll let you, do you want me to pick the questions, Ian?
Yeah, if you want to hop in there, I think you'll be able to discern. I'm still kind of doing some back end link dropping and clicking. So if you want to hop into that Q&A section, and guys, if you've posted them in the chat as well throughout this, if you want to repost them, there's a lot of links in chat. So if you want to put them in that Q&A, it'll It'd be easier to get to them.
Yeah, I'm actually pulling these from the Q&A. So if you really want
Perfect.
something answered, please drop it in the Q&A section. Okay, so what benefits have you seen to employees when CPA firms are purchased by private equity? Well, it's very mixed, right? I think, I was talking to, I don't know if some of you are old enough to remember the accountants boot camp that came through the industry in the 1990s. It was led by a guy named Paul Dunn and Rick Payne. Had a conversation with Rick Payne last week, and he mentioned to me that back in the 90s, American Express and CBiz were doing a lot of consolidation back then. And one of the things that happened was a lot of the top talent left those firms. And, so Will, I like your comment. He will work 80 hours and own nothing. I don't know if that's true. I think you know, some of these firms are very, very astute. They understand the need to keep good talent. Personally, I think the benefit you're going to see in the industry is you're going to see salaries go up more, more than they've gone up already. I think there's going to be a war for talent. I think that this industry is going to see probably more capital coming into it, and that is in some ways going to help people. I think the bad actors, the consolidators are not doing a good job, will have loss of employees, and it will be bad for them until they land in a better spot. Okay. Going through with the understanding that PE has a way to work, a structure, how do you as a broker adapt to it and share it with the seller? Well, I think, our job as a facilitator of these conversations is just to give our clients as much information as possible and let them make decisions as that are best for them. Everyone's situations are different. So I look at our job as merely the messenger, if you will, the educator. And I think too, most of these PE firms are negotiating with deals all the time, and they're very good at negotiation. So, one of the value adds we bring to the table is we help you negotiate. Our preference generally is to let negotiations flow through our team. And Morry, feel free to pipe in
Yeah,
on
look,
any of
I
these.
can add in there. I mean, I think there's, with negotiations, information is a huge advantage, right? And so if you've got one group on one side that's constantly doing negotiation, is very up to date on valuations, and you've got someone on the other side who has less information about that, I think it's very obvious what that type of negotiation is going to end up with in terms of a deal, right? I think where we come in is we're in the market, we know market terms that are out there, and so we're able to weigh in. If you've got a party, trying to make a transactional negotiation, we can be a sounding board for what typical market terms are, and can prevent deals that are one-sided.
Yeah. Jason asked, were first buyer and backup both PE, or was one a traditional buyer? You're mentioning the California deal that that we highlighted here. Those were both PE buyers. Well, here's an interesting thing: is a lot of times they don't identify that way. We have a lot of conversations with buyers. Like, oh, we're not private equity, we're a family office, or we're a CPA that's backed by a family office, or a different terminology. But I think I would put both of them in that same category, even though one of them might argue against that.
There's a question here regarding how multiples change based on EBITDA or revenue amounts, and is there a sweet spot of sizes where multiples start to increase significantly? Um, I'll weigh in here first, Brandon, and then you give me some of your commentary. I mean, what I'd say is that we're definitely seeing the most impact from valuations being higher, starting around the 5 million level, because that's kind of there's a critical mass of PE groups that are looking for revenue of at least that level. As the market has begun to get more competitive, particularly this year, as we mentioned, that's kind of dropped down as low as a couple million in top line revenue. So I'd say again, over 5 million, that's where you're getting the biggest boost. I'd say as low as a couple million, you're still seeing that boost where valuations tend to have shifted towards an EBITDA based multiple rather than a revenue. I think under 2 million, there I'd say it's still probably broadly looking at revenue multiples, but again, that depends mostly on what the buyer what their thesis is, right? So if you get if you get someone who is looking at it on a cash flow basis, that's still probably going to work out more favorable for you as the seller. But all of that comes down to the, what is in the head of the buyer and how they evaluate on their side. Are we just acquiring revenue and we assume that our operations are tight enough that we can improve margins and therefore we're getting the value, or are we buying the cash flow and then we're looking to expand that through growth strategies or efficiencies on the back end? Either of those is possible, and again, it just kind of depends on how the buyer is looking at it.
Yeah. Okay, next question. What's the proportion of sellers that want to stay on board and be part of a bigger project versus sellers that want to fully exit? This is from a buyer who's having a hard time finding sellers that want to continue. They usually want fully out. Yeah, I would say the reason most people are thinking about exiting is because they don't want to keep working. That's the majority of the people that we talk to. Where we find something that's kind of attractive for a lot of PE buyers is when we have multi-partner firms, and it might be the managing partner. I think we've had several of these instances, Morry, where it's the managing partner who says, "Hey, I want to get out. I want to exit, and I want to exit quickly." And then there are 3 or 4 other partners in the firm that are, have plenty of career left. And so sometimes that's a really good fit for a private equity buyer who needs owners and partners to stay on. So yeah, I mean, if someone is thinking about exiting, the main reason it's usually not totally financially motivated. It's more about them getting their time back. And so I think there are a lot of sellers who are willing to sell and stay on if they can scale way back. So if they can get all the administrative pieces off of them and kind of be able to focus on the things that they like in the practice, a lot of them will stay on for a little while longer. But most of them, most of them, there's a reason they're wanting to exit and talking about exiting. It's because they're ready to stop working.
We've got a question here on the 9 times EBITDA example and how that compares to a multiple of SDE, seller discretionary earnings, right? So there is some nuance there, and EBITDA is not necessarily a standardized number, right? And it certainly is different from SDE. And what I would say there is that obviously on the other side of the business, someone still has to be paid to do the work, right? And so previously all of that compensation would have been going to the owner. So there is an element of an indirect relationship between earnings on the other side versus sale price. And so I think that's where we talk about the employment agreements and the importance of that being, fair market value. And so basically you can kind of back out that amount from, this is sort of a crude way to do it, but you can roughly back out that amount from the SDE and kind of get to a rough approximation of what EBITDA would look like on the other side. And then that's kind of how you think about what the transaction value looks like. And so again, if you're trying to, if you want to stay on 3 to 5 years and you want that compensation to be above market, let's say, obviously that's going to come at a little bit of a reduction in the sale price. Alternatively, if you're willing to accept something that is at market or a slight discount, you can raise that price, and either of those could be a valid way to go about things. It just depends on which side you're playing for. Do you want the cash windfall now, or do you want the above market income stream for the next 3 to 5 years during your employment agreement? Those are pieces you get to negotiate during the process.
Yeah. Okay, I've got a question here. I'm both an owner and a buyer with capital. How do we compete with private equity when it seems brokers like you guys seem to steer sellers to private equity firms? We're not steering. We have a lot of individual buyers and we have a lot of firms that are buying. And for us, we really want a good fit for our clients and we want the buyers to be successful. We don't have a preference. We're here to make deals. That is our preference, is that we get a deal closed. I think what you're experiencing is just the market is shifting. There's a lot of demand for practices right now. Our buyer team is extremely busy right now. You know, I think our calendar for buyer phone conversations is weeks out. There's just a lot of demand, and so you're in a more competitive market right now. I would say PE firms are probably having the same challenge. They're not finding as many firms as they would like.
I would also add, there's some advantages of not being on the PE side, right? There are some sellers who actively don't want to sell to
Yep.
PE, right? And I think the other thing that you can focus on if you're, an individual owner with a bit of capital is, we've talked about fit a lot on this webinar today. I think if you can find firms where there's an alignment between the strategy of your firm, so maybe you have a particular niche, right? Maybe you focus on medical clients or something like that. You're going to be a much more compelling offer if you're making an offer on a firm that also is in that same niche versus a private equity group that may or may not have that niche, right? And so I think that you have the ability there, because fit does matter to most sellers as much as the actual price. So I think in general, if you've got a PE group that's got 100 million plus in capital, and you're not that large, you'll be at a slight disadvantage from a willingness to pay, obviously. But I think there are other ways that you can make that up. And then I think also the fact that valuations are going higher, I think that means you might have to pay a little bit more on the front end. But if you believe in your operations and you're buying a firm where you think that there are opportunities to either grow the revenue strategically or cut the expenses with a higher scale, you effectively can play the same game that private equity does, right? If you've got a couple $1 million firm and you acquire another firm that's $1 million or $2 million, suddenly now you're up in that 4 to 5 million range where the private equity guys are looking, and you'll get that valuation premium, so you can win not just on operations, but you can win on the higher multiple at exit.
Yeah. Yeah, and if I'll give a quick plug out to our Accounting Practice Academy. If you do own a firm and you want to get it ready for a sale and really maximize the value, or if you're buying firms and integrating them into your practice, Accounting Practice Academy is a great place to get resources on that. It looks like another buyer, I believe, to have a strong background as a prospective buyer. However, after submitting the buyer profile, I tend to have the seller decline without feedback. Would you have any recommendation? I would recommend that you ask for feedback. Our buyer team's usually very good about that if it's requested. And the other thing is sometimes we can provide pointers. We can spot things that are likely problematic for a particular seller. So feel free to ask our buyer team, hey, do you have any recommendations for my buyer profile before you submit it to the seller? We're happy to kind of critique those if you request it.
Got one here about how can you measure in a reliable way the magnitude of owner involvement in a CPA firm? Is it common to link deferred purchase price to transfer of responsibility from the owner to other colleagues. I'd say on one thing as far as the magnitude of owner involvement. So one of the things we look at is how many hours the owner is spending in the practice, right? So if someone's spending 2,500 to 3,000 hours a year and they're really doing the primary work, they would have a margin associated with that business, and that's probably going to be pretty high, right? If they're committing that much time to the entity. You compare that to a different owner who maybe is more absentee and maybe just does the business side of it and has hired people to take care of the actual accounting and tax work, and maybe they only spend 1,000 or 1,200 hours a year in the business, right? That's probably going to come with a lower profit margin, right? Because they're paying someone to make up that difference. But you've got to evaluate that and normalize those things out if you're a buyer on the other side, right? Because you've got to figure out who's taking care of the work. Is it from the acquiring firm staff, or is it from people that are staying on with the seller? So that will be a balance, and I'd say there's quantitative ways to measure it in terms of the hours involved, and then there's also just a structural and responsibility way to manage it in the sense of, is the owner doing the actual work, or are they more engaged in management and or biz dev?
Yeah. All right. Well, I think we will end on that note. It is 3:00 on the nose, and we appreciate everyone's time and attention. If you stayed with us this long, thank you again. That's I know that was a heavy amount of information for 1 hour. Any final words, Morry?
No, that's it. Thanks, everyone.
Thanks, everybody. Thanks for listening to the Accountant's Flight Plan podcast. You can keep the momentum going by subscribing and sharing your thoughts with us. Visit our website at PoeGroupAdvisors.com for more resources, and tune in next time for more exciting conversations like this one.
This podcast was produced and edited by Liesl Epps of Poe Group Advisors. Thanks for listening.